Every financial collapse in history has worn a different mask. 1929 was the Roaring Twenties hangover. 2008 was the housing bubble. 2020 was the pandemic shock. But beneath the surface, every one of these crashes followed the exact same path, a repeating pattern of greed, credit expansion, denial, and sudden collapse. Economists like Hyman Minsky once called it the financial instability hypothesis. But long before him, even in the 17th century tulip mania, the same cycle unfolded, an emotional roller coaster, where human behavior, not just numbers, dictates the fate of entire economies. Let's start with 1929 crash, the year Wall Street's greatest party came to an end. The 1920s had been a golden decade for financial assets. The stock market soared 600%. Easy credit was everywhere. Americans were buying cars, radios, and houses, not with cash, but with borrowed money. When the Federal Reserve raised interest rates to cool inflation, it triggered the first domino. Stock margins collapsed, panic spread, and within days, $30 billion in value vanished, a sum larger than the entire U.S. federal budget at that time. But the mistake most people make when studying 1929 is thinking it was unique. It wasn't. The same thing happened again 8 decades later, just with a new narrative. Replace stock certificates with mortgage-backed securities, and you get 2008. Replace tulip bulbs with dot-com startups, and you get 2000. Every collapse begins the same way, with optimism. When optimism meets easy money, speculation follows. When speculation meets leverage, bubbles form. And when bubbles form, history guarantees one outcome: collapse. Take Japan's asset bubble in the late 1980s. Land prices in Tokyo tripled in less than 5 years. At its peak, the Imperial Palace grounds were said to be worth more than all of California. By 1992, that fantasy was gone. Tokyo Stock Exchange lost over 60% of its value, and Japan entered a lost decade. It's easy to blame central banks or greedy investors, but the truth is it's human nature. Every generation believes they've found a smarter, safer way to make money. Every generation repeats the same mistake. We don't just experience these collapses, we create them. If you zoom out, the pattern becomes clear. Roughly every 8 to 12 years, a new boom begins, built on credit expansion, innovation, and optimism. Then, as profits soar, risk gets ignored, warnings are dismissed, and finally, the smallest trigger, like a rate hike, a bankruptcy, or a policy shift, pops the bubble. The Panic of 1837, the Great Depression, the dot-com crash, the 2008 financial crisis, and even the crypto winter of 2022 all follow the same emotional script. We think we've evolved, but markets are still ruled by fear and greed. In this video, we'll uncover the 5 hidden cycles, not just economic theories, but repeating forces that dictate the rise and fall of wealth itself. From credit and liquidity to innovation, debt, and human psychology, these cycles are the heartbeat of capitalism. And right now, as global debt hits $315 trillion, history suggests we're already deep into the late stages of another big crash. The question is not if the next collapse comes, it's which cycle will trigger it first. Before we start, make sure to like the video and subscribe to our YouTube channel for more informative content. First cycle is the credit expansion cycle. Every financial collapse begins quietly, not with panic, but with trust. Trust in the belief that this time the system is unbreakable. And nowhere does that trust show more dangerously than in credit expansion. Credit is like oxygen for the modern economy. When it flows freely, businesses grow, consumers spend, and markets soar higher. But when that flow becomes excessive, when money is borrowed not for productivity but for speculation, that same oxygen turns into gasoline. Let's go back to the early 2000s, right after the dot-com bust. The Federal Reserve slashed interest rates from 6.5% down to just 1%. The goal was to stimulate growth. What followed was one of the largest credit expansions in history. Banks began lending to just anyone who asked for it. Loans were given to people who couldn't afford them. Between 2000 and 2007, total household debt in the U.S. doubled. Mortgage-backed securities were sold globally as safe investments. Everyone believed housing prices could never fall. That's the first sign of a dangerous credit cycle, collective delusion. When the Federal Reserve eventually raised rates again in 2006, the bubble burst. Adjustable rate mortgages reset higher, millions defaulted, and the system, built entirely on borrowed trust, exploded. But this wasn't new. The same story played out nearly a century earlier, during the Roaring Twenties. Back then, margin debt, which is money borrowed to buy stocks, skyrocketed by 500% in just 6 years. Investors were buying shares with as little as 10% down payment, and when stock prices started to fall in 1929, the same thing unfolded. Forced selling, collapsing credit, and mass liquidation. Credit expansion doesn't just inflate bubbles, it also magnifies collapses. Because debt is not wealth, it's just a claim on future wealth. And when that future never arrives, the claim destroys the present. Look at China's property crisis today. For over a decade, developers borrowed trillions to build ghost cities, assuming demand would keep rising forever. Companies like Evergrande and Country Garden became symbols of growth at any cost. But now, as sales plummet and defaults spread, China faces the painful truth that borrowed growth was never real. The same cycle repeats everywhere: the low interest rates, easy borrowing, asset bubbles, artificial prosperity, painful correction. And it's not just housing or stock market. Even crypto markets followed the same script. In 2021, leverage exploded across exchanges. Platforms like Celsius, BlockFi, and FTX thrived on borrowed tokens and reused collateral. When liquidity dried up, everything collapsed in days. Bitcoin fell more than 50% in a few weeks, and this is the credit expansion cycle, the first hidden pattern behind every major collapse. It starts with abundance and ends in austerity. Governments then respond with bailouts, stimulus, or rate cuts, restarting the cycle all over again. That's why global debt doesn't just recover after each crisis. It grows. In 2000, total world debt was around $80 trillion. By 2008, it reached $140 trillion. By 2020, $250 trillion. And in 2025, it now stands above $315 trillion. We are living in an economy addicted to credit expansion, a system that can't survive without debt. The next cycle begins the moment central banks forget the last lesson. And history shows they always do. The next cycle is the Liquidity Mirage cycle. Every financial boom has a secret fuel called liquidity. It's the silent force behind every market rally, every housing boom, every crypto bubble. But here's where people get it wrong. Liquidity isn't real wealth. It's just borrowed confidence, an illusion created by central banks. And once that illusion fades, the collapse begins. After the 2008 crisis, the world's major central banks began a new experiment, quantitative easing, or QE. They flooded the financial system with money by buying government bonds and mortgage-backed securities, injecting trillions into the market. The results? Asset prices skyrocketed. Stocks, real estate, commodities, everything rose. But what many didn't realize was that this growth was artificial. It wasn't the economy that recovered. It was liquidity that made it look like it had. Take the S&P 500, for example. Between 2009 and 2021, it rose more than 500%. Yet during that same period, US GDP grew only about 60%. The stock market wasn't reflecting productivity, it was reflecting liquidity. When money is cheap and in abundance, investors stop asking questions. They chase returns. That's the liquidity mirage, the false stability created by easy money, and history proves it always ends the same way. In the late 1980s, Japan experienced one of the largest liquidity-driven bubbles ever recorded. The Bank of Japan kept interest rates at record lows, fueling a bubble in property and stocks. At its peak, the value of Tokyo's Imperial Palace grounds was said to be worth more than all the real estate in California. Then, in 1989, the central bank pulled back. Interest rates soared high, liquidity evaporated, and within 3 years the Nikkei lost over 60% of its value, and Japan entered what would later be called the lost decade. The same pattern appeared in 2022, when the U.S. Federal Reserve began its most aggressive tightening cycle in 40 years. For over a decade, markets had been addicted to zero-interest liquidity. But when rates rose from 0% to 5% in just months, the illusion cracked. The Nasdaq dropped over 30%. Crypto lost nearly $2 trillion in value. Banks like Silicon Valley Bank collapsed under the weight of unrealized bond losses, all because liquidity vanished. Here's the brutal truth. Modern markets are no longer driven by fundamentals. They're driven by flows. When central banks inject liquidity, money flows in. When they pull it back, everything deflates. That's why, despite all the talk about innovation and productivity, the real question investors should be asking is simple. Is there liquidity in the system? If there is, markets rise. If not, they fall. This dependency has made the global economy fragile, like a patient surviving on constant oxygen. Each round of stimulus keeps it alive, but weaker. You can trace every major collapse to the moment the liquidity tap was shut off. 1929, when margin lending was restricted. 1997, during the Asian financial crisis when capital outflows crushed currencies. 2008, when interbank lending froze. 2022, when the Fed ended QE and began QT, quantitative tightening. Each time, markets believed the good times could continue forever, and they were wrong each time. Because liquidity is not wealth, it's the illusion of wealth. The third cycle is the confidence trap. Markets don't move on numbers, they move on belief. Belief that governments can control chaos. Belief that central banks can print stability, and that this time is different. Confidence is the invisible thread holding every financial system together. But history shows that once that thread snaps, the fall is swift and merciless. Let's rewind to October 1929. Stock valuations were extreme, margin debt was completely uncontrolled, and yet headlines reassured everyone. Stocks have reached a permanently high plateau. Those words from economist Irving Fisher were more than optimism. They were a mirror of collective delusion. Within weeks, that confidence collapsed. By 1932, the market had lost 89% of its value, and the U.S. economy plunged into the Great Depression. Fast forward to 2008, Wall Street had engineered a trillion-dollar system built entirely on subprime mortgages. Investors, regulators, and even homeowners believed housing could never fall nationally. That belief was what made the crash so devastating, because when trust disappears, liquidity freezes, credit dies, and fear takes over. This is the confidence trap, the point where optimism blinds society to gamble their entire life savings. Look at the dot-com bubble of the late 1990s. Startup founders with no profits raised millions on a dream. Investors bought domains, not businesses, and when confidence evaporated, over $5 trillion in market value vanished within months. Even cryptocurrency followed the same pattern. In 2021, the world believed decentralized finance would replace banks. Bitcoin was hailed as digital gold. Then Terra Luna collapsed, Celsius froze withdrawals, and FTX, the biggest crypto exchange, collapsed overnight. Billions evaporated not because the technology failed, but because confidence died. Confidence fuels every bull market. But it's also the first reason of every crash, and after each disaster, a new generation forgets the pain, convinced they're smarter than the last. In 2020, during the pandemic, the same trap appeared again. The world shut down, yet markets soared. Why? Because trillions in money printing restored confidence, not fundamentals. People believed governments could spend infinite amount of money without any consequences. Today, inflation is the reminder that confidence always has a cost. Economist John Maynard Keynes once said, "Markets can stay irrational longer than you can stay solvent." But he might as well have said, "Confidence can stay inflated longer than truth can be heard." Confidence keeps economies alive until it becomes complacency. When investors stop questioning, when citizens stop saving, when leaders stop warning, that's when the fall begins. The confidence trap always ends the same way. Euphoria turns into denial. Denial becomes panic. Panic becomes collapse. And then the rebuilding begins with a new story, a new market, and the same old human behavior. Confidence builds civilizations, but overconfidence destroys them. Every financial collapse leaves behind wreckage, bankrupt companies, job losses, broken trust. But what comes next is just as dangerous. It's political intervention. Because in modern economies, markets no longer correct themselves. Governments do. And each time they step in to fix a crisis, they become the reason for the next crash. Let's go back to the Great Depression. After the 1929 crash, governments around the world tried to restore order. In the U.S., President Franklin D. Roosevelt launched the New Deal, a massive public spending, infrastructure projects, and new regulations to stabilize banks. It worked for a while. Confidence returned, unemployment fell, and growth resumed. But the same intervention also gave birth to something new, permanent government involvement in markets. And from then on, every downturn became a political issue, something to be managed, not endured. That's where the political response loop begins. When markets fall, politicians fear public backlash, so they print money, lower interest rates, and bail out industries. That short-term relief wins votes, but long-term, it creates a bubble. Consider 2008 again. The financial system was collapsing under its own weight. Instead of letting markets reset, the U.S. government approved a $700 billion bailout under TARP. Central banks lowered rates to near zero. The message was clear. We'll save you, no matter the cost. That moral hazard became permanent. Every investor learned that risk wasn't really risk. It was an opportunity subsidized by taxpayers. When profits rise, they're private. When losses hit, they're public. By 2020, that mindset was fully established. As the world locked down, governments didn't hesitate. They printed money at historic levels. In the United States alone, over $6 trillion were printed out of thin air. Global debt soared past $300 trillion, and the result? Temporary relief and lasting inflation. Now, as central banks struggle to control prices, they're caught in the same loop. If they raise rates, economies slow down and markets panic. If they cut rates, inflation returns and bubbles grow. This loop doesn't just distort markets, it changes society itself. The wealth gap widens as asset owners benefit from bailouts, while ordinary citizens face rising costs. People lose faith in capitalism, leading to populism and polarization. From Brexit to Trump, from France's yellow vests to Argentina's currency collapse, every political shock of the past decade traces back to one thing: the economic distortions caused by policy intervention. We've seen this story before. In the 1970s, excessive government spending and oil shocks triggered stagflation, slow growth with high inflation. It took Paul Volcker's brutal rate hikes in the early 1980s to break the cycle. But in today's world, no one dares to repeat that medicine. The political cost would be too high. And so, every crisis becomes another justification for intervention. Every bailout creates new risk takers and breeds the next collapse. That's the political response loop, a self-reinforcing cycle where fear of short-term pain guarantees long-term instability. As of 2025, we're seeing it unfold again. Governments are running record deficits to support growth, while central banks quietly debate when to restart QE. So the next collapse won't come from what politicians ignore. It'll come from what they can't stop doing. In today's world, no economy collapses alone. A bad financial move in one corner of the globe can cause a collapse in some other nations within days. This is the global contagion effect, the invisible web that connects banks, currencies, and markets in ways most people never see, until it's too late. To understand it, we need to go back to 1997, the Asian financial crisis. It began quietly in Thailand, when the Thai baht lost its peg to the US dollar. Investors panicked. Within months, currencies in Indonesia, Malaysia, and South Korea collapsed. Stock markets across Asia lost more than 70% of their value, and over 20 million people fell into poverty. But the most terrifying part? None of those countries were directly connected, at least not on paper. The contagion spread because of confidence. Once foreign investors lost faith in one Asian economy, they pulled money from all of them. That's how modern finance works. Fear spreads faster than data. Fast forward a decade to 2008. When Lehman Brothers collapsed, it didn't just take down Wall Street, it paralyzed the global system. Banks in Europe, Asia, and even Africa froze because they all held the same toxic securities. The collapse of one institution triggered a chain reaction through the global credit market. Within weeks, Iceland's entire banking system was destroyed, and even solid economies like Germany and the UK faced recession. In a globalized world, financial systems are no longer independent. They're connected to each other. A crisis in one sector or even one company can ripple through supply chains, currencies, and commodities. In 2020, when COVID-19 shut down global trade, that interconnectedness was exposed again. Oil demand crashed suddenly, and for the first time in history, U.S. crude oil futures went negative, meaning producers had to pay buyers to buy oil from them. Global trade fell by 15%, and within weeks, the shockwaves reached every corner of the world. Even now, in 2025, we see the same happening. China's slowing economy affects commodity exporters in Africa and Latin America. A rate hike by the U.S. Federal Reserve tightens liquidity in emerging markets. A war in Eastern Europe sends energy prices skyrocketing in Asia. The global contagion effect ensures that no collapse stays local anymore. This isn't just about finance, and it's about systems. The global supply chain is built like dominoes. It's efficient, but brittle. Just one disruption, a pandemic, a war, a cyber attack, can trigger inflation, scarcity, or social unrest. Even digital assets aren't immune. In 2022, when crypto markets crashed, billions were wiped out across continents. Investors in Singapore, Dubai, and London all suffered from decisions made in the Bahamas, where FTX was headquartered. That's the new reality. In a world connected by code and capital, collapse travels at the speed of information. The danger is that while our systems have become more complex, our safeguards haven't kept up. Regulators operate nationally, but risk is global. Central banks print independently, but debt flows internationally. We've built a financial ecosystem where every player depends on every other, and no one is fully in control. The global contagion effect means every crisis today is a shared one. No economy can truly decouple. No market is isolated. It's a single massive structure, one that keeps expanding, tightening, and vibrating with hidden tension. And just like a spider's web, the larger it grows, the easier it tears. Every financial crisis may seem different, for example, a virus, a housing bubble, a war, or a debt default, but all happen in the same exact pattern. The 5 cycles we've explored, credit expansion, liquidity mirage, confidence trap, political response, and global contagion, don't operate in isolation. They feed each other, and together they form the grand pattern that defines the rise and fall of civilizations, the collapse cycle. It begins in prosperity, a period of optimism, innovation, and easy credit. Interest rates are low, money is cheap, and the future feels limitless. Governments borrow to fund growth, corporations expand, consumers spend. Debt becomes the foundation of progress, and as long as asset prices rise, no one questions it. Then comes euphoria. Markets boom, liquidity floods the system, and speculation becomes normalized. Investors stop asking what something is worth. They only ask how fast it will rise. This is when leverage peaks, when risk feels like opportunity, and when the smartest people in the room start saying, "This time it's different." The next phase is strain. Inflation creeps in, asset prices outpace reality. Central banks, pressured by politics and fear, begin tightening. Liquidity evaporates and confidence starts fading. And then, the smallest shock, a bankruptcy, a missed payment, a rumor, lights the fuse and collapse follows. Markets crash with terrifying speed and panic replaces profit. Banks close, businesses fail, governments scramble, and the same policymakers who once preached fiscal discipline suddenly unleash rescue packages, rate cuts, and money printing, restarting the political response loop all over again. But here's the dark truth. Every rescue makes the next collapse worse, because each time it creates more debt than the last. That's why world debt has risen from $80 trillion in 2000 to over $315 trillion today. We are not escaping the cycle. We are amplifying it. And eventually it all comes to a reset. After years of pain, defaults, and devaluation, the system regains confidence. Liquidity flows in. New industries emerge. A new generation, unscarred by the last crash, steps in with fresh optimism, and the cycle begins again. History records this pattern over and over again, and every time humans convince themselves they've mastered the system, that technology, regulation, or innovation can manage the risk. But in reality, the system isn't broken. It's behaving exactly as it always has. The collapse cycle is not a prediction, it's a pattern, as old as credit itself. And right now, the indicators are all flashing red. Record debt, inflated asset prices, geopolitical tensions, and central banks trapped between inflation and stagnation. If history holds true, we're not heading toward a crash. We're already inside one, waiting for the moment confidence gives way. Because the end of every financial era doesn't begin with panic, it begins with belief. The belief that it can't happen again. And that's when it always does.